Have you ever wondered what it looks like when a financial giant falls? What happens when a bank trusted by the most innovative companies in the world simply runs out of money? Today, we're diving deep into the dramatic 48-hour collapse of Silicon Valley Bank, a story of ambition, panic, and the shocking fragility of the modern financial system. Imagine this. It's a regular Thursday in the heart of Silicon Valley. Tech founders are pitching their next big idea, venture capitalists are writing checks, and the engine of innovation is humming along. The financial backbone of this entire ecosystem? Silicon Valley Bank, or SVB. For over 40 years, SVB wasn't just a bank. It was a partner, a lifeline for startups and the VCs who funded them. It understood the tech world's unique rhythm of boom and bust. Its reputation was solid gold, but in less time than a weekend, the reputation would be shattered and the bank would be gone. How did it happen so fast? That's the story we're here to tell. To understand the collapse, you first have to understand SVB's special role. Founded in 1983, it carved out a niche by serving tech startups, companies that traditional banks often found too risky. If you were a founder who just raised millions in venture capital, SVB was the place you parked that cash. They managed billions in deposits from a who's who of the tech world. They offered loans, credit lines, and financial advice tailored specifically to high-growth companies. SVB was embedded in the DNA of Silicon Valley. It was the financial institution that helped build the future. This very specialization, however, would become its fatal flaw. Beneath this shiny surface of success, a perfect storm was brewing. The first problem was concentration risk. Think about it. Most of SVB's clients were tech startups, all funded by a relatively small group of venture capital firms. When one part of this ecosystem gets a cold, everyone starts sneezing. During the tech boom of 2020 and 2021, startups were flush with cash, and deposits at SVB swelled to unprecedented levels. The bank had to put all that money to work. And that leads us to the second, more critical problem: interest rate risk. With all these deposits flooding in, SVB made what seemed like a safe bet at the time. They invested billions of dollars into long-term U.S. government bonds and mortgage-backed securities. When these bonds were purchased, interest rates were near zero. These were considered among the safest assets in the world. What could possibly go wrong? Well, the Federal Reserve. To combat soaring inflation, the Fed began aggressively raising interest rates throughout 2022. This had a devastating but predictable effect on the value of SVB's bonds. Here's a simple rule of finance. When interest rates go up, the market value of existing, lower-rate bonds goes down. Suddenly, SVB's massive bond portfolio was worth billions less than what they paid for it. This created a massive unrealized loss on their balance sheet. As long as they didn't have to sell those bonds, it was just a paper loss. But what if they needed the cash and fast? The warning signs were there. Internal risk assessments pointed to the dangers of their concentrated deposit base and their exposure to rising interest rates. But it seems management either underestimated the severity of the risk or was too slow to react. They were caught in a classic trap: complacency born from years of success. They believed their deep relationships in the tech community would shield them from the kind of panic that brings down lesser banks. They were wrong. The tipping point arrived on Wednesday, March 8, 2023. In a desperate move to raise capital and shore up its balance sheet, SVB announced it had sold a portion of its bond portfolio at a nearly $2 billion loss and was trying to raise over $2 billion more by selling new shares. This announcement was meant to calm nerves, but it did the exact opposite. It was a public admission of weakness. The news spread like wildfire through the tight-knit world of venture capital. VCs, whose job is to manage risk, saw the red flags immediately. Influential figures began advising their portfolio companies to pull their money out of SVB just to be safe. And that's when the modern bank run began. This wasn't like the old days of people lining up outside a bank branch. This was a digital bank run, happening at the speed of a text message, a Slack channel, and a viral tweet. On Thursday, March 9th, panic went into overdrive. Founders scrambled to log into their SVV accounts, trying to wire out millions of dollars. The bank's systems were overwhelmed. Withdrawal requests flooded in, totaling an astonishing $42 billion in a single day. Imagine a quarter of your bank's total deposits being requested for withdrawal in just a few hours. No bank on earth can withstand that. The very community SVV had so carefully cultivated was now, in a desperate act of self-preservation, tearing it down. Regulators at the FDIC were caught off guard by the sheer speed of the collapse. By Friday morning, it was over. SVV was insolvent. It couldn't meet its depositors' demands. Federal regulators stepped in, seized the bank, and shut it down. Silicon Valley Bank, a $200 billion institution and the 16th largest bank in the United States, had failed. It marked the largest bank failure since the 2008 financial crisis, leaving the tech world and the entire financial system in a state of shock. So, what are the big lessons from this spectacular implosion? First, liquidity is everything. SVV was technically profitable and had a stellar reputation, but it didn't have enough cash on hand to survive a panic. Reputation can't save you when your customers all want their money back at the same time. Second, diversification is not just a buzzword. It's a survival strategy. SVV's reliance on a single industry tech and a narrow investment strategy in long-term bonds created a ticking time bomb. When both the tech sector and the bond market turned against them simultaneously, they had nowhere to hide. And third, risk management must be proactive, not reactive. Ignoring internal warnings and failing to act decisively turned a manageable problem into a catastrophic failure. The crisis also exposed the power of social media to amplify fear and accelerate a bank run to unprecedented speeds. For every startup founder, investor, and even for us as individuals, the SVV story is a powerful reminder that no institution is too big or too trusted to fail. It forces us to ask tough questions about where we put our money and how we assess risk. The collapse of Silicon Valley Bank is a cautionary tale that will be studied for decades. It's a story of how quickly confidence can evaporate and how interconnected our financial world truly is. What do you think? Could this crisis have been avoided? If you were a founder with all your company's cash in SVV, what would you have done in those frantic hours? I'd love to hear your thoughts down in the comments. Thanks so much for watching. If you found this breakdown insightful, please hit that like button and subscribe to the channel for more deep dives into the stories that shape our financial world. We'll see you in the next video.